Welcome to Real Estate at Work. This is your place to network, learn, and grow your business. That's what it did to my business, and I hope you can do the same. We have the most amazing guest of all time today, and I cannot wait to share his story with everybody. A few months ago, I was looking for my first commercial project and was introduced to Matt because of the kinds of deals that he was putting together and putting under contract. And as I started to know Matt and learn his business and his vision, I got super intrigued and we continue to keep in touch. And so today we're really excited to share him with all of you because every time I've had a conversation with Matt, I'm like, man, I'm craving more. So super, super cool. What is different about Matt is he can take something super complex and simplify it so that it's easily digestible, even by me. So I think that's what I really like about Matt and how he structures his deals. So Matt, welcome to Real Estate at Work. I would love to know how you were able to create like $100 million rental portfolio in such a short amount of time. It's pretty spectacular.
Thanks for having me on, guys. Really great to be here. Love the show. To be clear, about 3 years ago, I was in school and I think I had probably $100,000 maybe, and not a lot of time. And so I'm very relatable in the sense of born in Fort Collins, Colorado, traveled a lot, lived in Mexico City with my parents for 5 years, who did mission work, came back to the States, went to 10 different colleges. I was a paramedic, nurse, firefighter before going to get my doctorate in anesthesia from Mayo. And then, that was about 4 years that I spent in Mayo Clinic in operating rooms. And then came out, did some of that, and then transitioned to real estate. So kind of has been an interesting path, but it's been a lot of fun, and happy to share the story here.
So why did you pick anesthesiology?
Well, my parents were like kind of pushed. My grandfather was a neurosurgeon at Mayo. He was one of the top 10 actually in the world. And he was never around for my dad. And so that was just, they were just like, hey, don't go into something super specialized where you're the only guy and everybody else who botches a surgery, you're going to get the worst, most complicated cases and always be on call, right? So I went for something, that was more kind of shift work where I could have a family and probably pick my hours more. So that was the draw there. And, I just thought that I could in a lot of different ways. And it just kind of happens, you go in, you start doing clinicals and you're like, okay, I don't want to see patients in an office setting. I like the skills. So I like, IVs, intubations, lines, and I also like being able to have one patient, you have them for an operation and you pass them off. So it was like, hey, I can establish rapport quickly, be able to help this person, and then, not have to have them for 3 months and, that kind of a thing. So I enjoyed the flow. And I think that's why I ended up choosing anesthesia.
And so then what introduced you to real estate investing?
Well, I had a friend who was a general surgeon named Randy, and he said, I went over to his house and he had like 3 or 4 other people in his house in the kitchen. And I was like, Randy, who are all these people? And he's like, well, they rent rooms for me. And so he was living for free. He was a general surgery resident and he was house hacking, which I'd never heard of before. And then he was also at this 12-unit apartment building that his grandfather had helped front the money for. They were rehabbing it and they were going to refinance it then, and he was going to be able to hold that. And I'm like, okay, if this guy who doesn't really have much income, I mean, residents make $50,000 a year or something, and has no time, and he was married, and we're having a baby. I'm like, if he can do it, surely I can. And he was like, have you ever heard of this podcast called Bigger Pockets? And that was about 5 years ago. So I started listening to the podcast and knew that I needed to reach out, started, doing a lot of education. And, I think that's when I found some mentors. And my first deal was a 14-unit apartment building. And, I, at the time, didn't have any money, wouldn't have the ability to get the loan. And I knew that the rents were low on the building. I knew they didn't have coin laundry. I knew they weren't charging for parking. And so I said, hey, if you'll put up the money, I think I can double your money in,
Right.
about 5 or 6 months. We actually did it in 4 months. We bought the building for about $835,000. We sold it for just over $1 million 4 months later. So
this is you and Randy were doing that?
That was a different investor. His name actually was Jacob, and he didn't do anything with the building. So I was on my evenings, weekends, that kind of stuff. I was over at this apartment building raising rents. I bought these, I'll never forget it. I had a 5-gallon bucket and I was going down to these coin like laundry things. And I would sometimes I'd bring a friend or whatever, when you're holding the bucket, trying to get all the quarters, into the buckets. And, you never forget those experiences. And, it was not easy. Like, we got pushback from the tenants. Just management of that kind of stuff is all usually more intensive, especially when you're more in class C or D, type properties. So this was low, I was moving rents from 450 to 700 or 750, that was on the rent. So it was just a whole different ballgame, but it helped me understand net operating income, and that commercial properties are valued off a multiple of that, right? Using a cap rate. And so I quickly learned that it was this magical difference between single family rentals that are based off comps, and the commercial property was you're buying an income stream rather than a comparable home. And when that clicked for me, I realized that there was really no ceiling on that. So after that, on my own, I used a physician loan on a couple of homes, bought on there, like no money down, no mortgage insurance, tried to do some rentals, and realized that just wasn't scalable. And then I moved on to triple net investing by buying.
So were you buying those properties as like single families with no money down? So acting like it was your single family, and then buying the next one, like whatever, 6 months later or whatever, and then keep doing the same thing. So could you keep doing the loan, or once you used it, it was gone, kind of like a VA or something like that?
So these are a little bit different than VA because they're portfolio in-house loans. And if you're in a town like Rochester's, they're used for people who likely are going to have a lot of debt, but high income potential coming out. So they're owner occupant loans. So I would buy it, I'd move into one of the rooms, and then I would have 4 other bedrooms that I could rent out, and then you hold it for a while, and then you could do it again. And after doing 2, I'm like, this is stupid. I got to get out of this. And I had one of them until like 6 months ago. So I sold one pretty quick. And then I had moved a family into the other one and ended up selling it, I don't know, 5 or 6 months ago. So no more homes for me.
All right. So you had a 14 unit, a couple of these single families that are probably hacked into 4 units, 5 units essentially, but probably an SFR. What then got you to the next step, or what was the next step after that? After you realized, all right, I don't want to live with 4 or 5 people that are probably maybe arguing with each other and maybe not getting along.
So at that time, I'd continued to build relationships, and that's what I would say is just like network is net worth. And I had been talking to a lot of these brokers, trying to educate myself. I always thought it was apartments, and I had a broker come to me and he goes, "Hey, I got an idea. I got a friend who has a strip mall, and he'd be willing to help you with some of the financing." So we were able to get 80% from the bank, 15% from the developer, and then I raised 5% as private money. I think that's the biggest thing I would say is when you understand the fundamentals, if you understand real estate and you have the hustle, you don't necessarily need the money to start. Is it helpful? Absolutely. But the money will come, especially in this environment, when we're heavily liquid. So it was a $2.25 million strip mall with 7 tenants that had been built, and had random, a couple tenants were good. I had like a Topper's Pizza, Metro PCS, and then these like Asian restaurants. And it was interesting to say the least, but it was a great property. I bought it in 5 or 6 months. We had a 1031 buyer that needed a replacement property, and it worked perfectly for them to come in, and made about $540,000 that I was able to 1031 exchange. And once you have one of those experiences, it changes everything for you. It's very difficult to ever go back.
Okay,
So,
wait.
So the 80% that you financed, was this with the same kind of partner for the single family that you did, or was this someone different?
So the 80% comes from the lender, came from the bank, 15% came from the seller of the property, and that's what's called a seller carry. So we see this fairly commonly, and sometimes you can align interests where the seller will have a large tax liability. So I've done contracts for deed. I bought a $12 million building in downtown Rochester on a contract for deed, where the beauty of it is it's entirely negotiable. You just say, okay, how much money are you comfortable with me putting down? The seller then becomes the bank, and you're able to do it that way. So like right now I have 216 units in Hudson for 18 million that we're looking at doing on a contract for deed. And eventually you get a strong enough balance sheet to where they don't really care. And a lot of times they don't want their money back, right? So the beauty of those are entirely negotiable. And I think as you get into larger properties, the financing can be much more negotiable. And, this is different than like Fannie Freddie debt on apartments or, single family type loans where there's a lot of regulation. This is more like other investors that are deciding if they're going to give you the loan or not, right? And so the story matters and the relationships matter.
Right. And so how long did you hold on to that first deal?
About 5
Acquisition to exit.
Yeah, 5 months probably.
That's
And
amazing.
Yeah, you'd be surprised. There's a definite inefficiency in the market, and
Right.
we see, I would say that it's more so in 10 million and under probably. So now a lot of the transactions that we do, my competition are, institutions, REITs, trusts, those kind of things when you're 10 million plus in a purchase price. But under that, you have this window of mom and pops usually can't buy stuff that's much more than 2 or 3 million bucks, but institutions are looking for scale and they don't want to buy under that. So, what I would say is once you get that first property, when you can hang in that window, you'll find inefficiencies where, something's there's management reasons, or there's opportunities, sometimes people need to sell at the end of the year for tax reasons, those kind of things. So as you start to be able to feel the market, you'll be able to have those opportunities come up pretty consistently, actually.
And so these lenders are also not underwriting you as the buyer. They're underwriting the deal, correct? They're underwriting the leases.
It's definitely weighted more that way because you're buying an asset, not a liability, right? So the primary source of repayment is the tenant. And that's, they're only putting out usually 80% against the building in a first lien position. So are they underwriting me as a borrower? Yes. But it's more of it's not weighted as heavily because I'm kind of the secondary source of repayment. So they're more just looking like, hey, is this a bad guy or not? You know what I mean? Like I can't really add to the deal, but I can subtract if I've got something, like bad credit score, those kind of things. But in general, there are ways to mitigate that though, too. I mean, where you can bring in an additional guarantor or, a contract for deed. A lot of times they're not going to be checking that kind of stuff as well. So even if you do have a low credit score, there's ways to get over that.
Right. So for the benefit of our audience, can you go through what some of those leases are? Like what is a triple net lease? What is a ground lease? If you can go through that, that would be awesome.
Yeah. So on a typical lease, when you have like a home or an apartment building, it's basically a lot of times gross, right? Or maybe a modified gross where they're paying utilities, that kind of parking or whatever. A triple net lease is usually a larger company where they're paying the, taxes, insurance, property management, all those kind of things. So, and there's different steps. So like on a double net lease, maybe the landlord's responsible for a roof and parking lot. A triple net lease, the tenants would most likely be responsible for that. There's variations of it. An absolute net lease means, the tenant's responsible for everything. And then a ground lease means you don't even own the building, you just own the dirt underneath it. So if they don't want to extend the lease, they just give you the keys to the building at the end and that's yours. So it's really nice to be able to see that you can really structure any lease how you want, and most of the time I'm buying stabilized properties where we're just assigning leases. But occasionally we will do sale leasebacks where through direct mail, we find an operator who owns a business and they're like, hey, we're open to this. And you have to sit down and educate them, right? And so that's what we found some really great opportunities in structuring. Like we had one recently that was a cabinet shop, 93,000 square feet of commercial space. And they've been there since 1966. They own the building and we're like, hey, we think we can put about, $4 million in your pocket if you guys will sign a lease with us and sell your building. And these guys are, they just run a business. They don't understand real estate, right? And when they do that, it's probably worth 5 million. You know what I mean? So like you can create these win-win situations where we come in, we'll structure it where, they'll sign a 5-year deal with a 5-year option. An option on a lease means that the tenant can exercise that and stay longer. So that'll usually predetermine what rent will be, and it's largely to protect the tenant, and lays out what the rent bumps would be and that kind of a thing.
So that's the sale lease back. How did you go about thinking of that or getting into that? It just seems insane. But it's kind of like something that I think makes, so you're essentially they're pulling money back out, kind of like a refi, or how is that different? I guess walk us through that, the sale lease back, because I know you love those things. So
yeah, so the value of the building is in the lease, and when you understand that, it's not just sticks and bricks we're buying, right? We're buying a stream of income, and that's really what all of our due diligence is about, is making sure that that income stream is strong. So we go in and we understand that at a certain net operating income, then the value, that's where we derive value. So a lot of it's been through mentorship, through finding other people that have done that, and then even through our own buildings where we're extending leases and you're working with attorneys, that kind of a thing. And so you learn, okay, this is how a bank would value this, and those kind of things.
Interesting. So do they still own the property, or at that point you own the property and then they have the option to buy back after the 5-year term, or they've got the options, they can keep doing the options? So you're holding the property, they're running everything. So they're responsible for taxes, insurance, whatever they kind of want to do there.
Yeah, so usually they'll sign on like a 5-year term, and the option is just for them to extend their lease. So usually we don't have, for them to buy a property back, that's called a right of first refusal, which is something very separate. And if you have a right of first refusal, which is great, if you're, if you want to get the money, but you think maybe your business is going to grow a lot, that, would be really smart to put that in. But an option simply indicates that you can stay longer if you need to, and it protects the tenant that you're not going to jack the rent on them. Interesting.
Those, I think there's a lot of value in those things. How many of these sale leasebacks have you done?
Probably 10 or something like that. So, they're on fairly large properties. And so I think one of the things you can do is you can learn that, okay, here's how I can sit down with, whether it be an owner, seller, those kind of things, and come from a position of understanding what they need, and how do we get them what they need, right? And so if you can start solving other people's problems, that's where the way to make money is to have other people give it to you, okay? And the way that you have other people give you money is by solving their problems, right? That could be an investor who he needs an investment, or he needs deferral, right? So a lot of times I can help investors get into properties where they don't pay taxes anymore, right? So I quickly learned that the number one expense I had in my job was that I was paying 6 figures in taxes. Some people are paying 7 figures. So if I came in, I said, hey, let's file your spouse as a real estate professional, take huge bonus and accelerated depreciation, and take that out against your ordinary income, all of a sudden I can solve a very large problem for them, get them, and it's providing value, right? And so for me, I learned early on, if it works to take out $1 million loan and have a tenant pay it off, why doesn't it work with 5 million, 10 million, 100 million, right? And I think that's where as I've transitioned into commercial real estate, that's where I realized, like, you can choose what your net worth is. And I've started thinking more about net worth rather than cash flow, because as you take these steps of financial independence, you'll cover your expenses, and then you'll replace your income, and then you're just continuing to buy buildings, to buy toys or whatever you want. You know what I mean? So I think that's a thought process of how to create lasting wealth is very different than how do I cash flow $1,000 a month on a home, right? And so when you can kind of change that frame, you get different results. And bigger isn't harder. Bigger is just bigger,
I mean, I hope you guys are like taking notes, because this is blowing my mind. There's so many good nuggets here. We are going to be recording this, and we'll have it up on our YouTube channel. So go back and rewatch, because this is amazing. Sorry, Brad, go ahead.
No, you're right. And I agree 100%. It blows my mind. And I knew going into this, I'm like, I don't know much about this, so this is amazing. I'm probably going to ask stupid questions, but it's just because I'm trying to learn more about it. As far as, I mean, I'm more visual, probably. I don't know, like, if you're as visual like I am, but do you have any deals, maybe like all right, here's an amazing deal we did that maybe wasn't one we talked about, or maybe it was one we talked about. You could kind of walk us through it. Like, sure. This is what I did. Here's what I did. Here's those tax incentives or whatever. Perfect.
Yeah, let me pull one up here. So these are deals that we have going on right now. I don't know if you guys can see this, but these are deals that'll close these are deals that'll close in the next 60 days. So that's about 150 million. These are going under contract is about 10 million. We have another 72 that we're doing right now. So obviously we got a lot of deals in progress. We've closed probably, I think we've closed maybe 250 million this year. So I think if we go into the deal, I got a bar at the top I'm trying to get rid of. Here we go, deal calculator. Let's see if we go, let me get a different one here. So here would be an example of a transaction that we could walk you guys through. So, this is a real, this was a real deal. So this is a huge industrial facility down in Illinois. But here's some typical bank terms: 80% leverage, 25-year amortization, 5-year term. So 7% cap rate on the property. Usually we're 6 to 7 cap. This is industrial, so low rents per square foot, low price per square foot. This particular buyer was going to put about 10% down. We're going to sell or carry about 10%. So you're seeing like a 17% cash on cash. And again, these vary deal to deal. And so, but the internal rate of return here is 60%. But even if the person was putting full 20% down, you'd be looking at 10% cash on cash, probably, and 30% IRR. And so that would be an example, of a transaction.
And the bank loan, that's the investor you're working with. He's going to be on the bank loan. Is that correct?
Correct. Cool. So it depends. You can structure it however you want. You can, if you want to raise money and bring that in from private investors, that's the beauty of an LLC. They could all be, you could have multiple members. Anybody who owns more than 20% of an entity has to sign on the mortgage. Okay, so that's an important thing to be aware of. But outside of that specific deal, we do assign and double close properties. So I have more properties than I can close alone. So I basically go under contract at a certain number, assign the property, and I'm making money. Sometimes I'm seller carrying back. It really depends on, the opportunity. But interestingly enough, I saw Brant Kummerfeld's on here. He's closing with me next week on an $8 million deal down near Milwaukee. So yeah, I mean, it depends every time. Like he has a 1031 exchange that he needs to roll funds in, right? But the beauty of it is if you look at cost segregation and bonus depreciation, you basically take like 80% of the deal size. And so that's usually what building value is roughly. So you can't depreciate land. Land is usually at least 10, 20%. And then you take 28% of that. And so that's what you can use in year one right now under Trump tax law. So my adjusted gross income last year was negative 13 million. Because you take this depreciation, you put it on your tax return, and it carries forward for 20 years. And so that's what I would say to you is we're in a window of time where basically the IRS system is here's a bunch of rules, and if you follow them, we're going to reward you, right? And so that's what I would say is think about, get the right people around you who can say not, like you can't do this, but how can we do this, right? And then maybe you start engineering your life to be able to take full advantage of the incentive plan that's been rolled out, if that makes sense.
And that seller carry on that was you at one point. That's you for 1.4 million or whatever, and you're getting I think 4% off of that. So you have like passive income that's coming in of 1.4 from that seller carry that you had for that property. It's genius. So
the point is essentially you're creating win-win scenarios where you're lowering the hand down of what somebody did for me, right? And that's and not every transaction's that way. I mean, we have an investor right now that has, 13 million in cash that he's trying to place. So like, there's going to be nothing needed there, but it just depends on the investor. And so I think a lot of people, when you look at, and I'm not a real estate broker, but a lot of brokers are just like trying to sell a deal here or there. And what we do at Wild Moose Ventures is try to look at the whole picture and say, hey, share share what your goals are, right? Let's start with that, not buying or selling a deal, but like, who do you want to be in 5 years? Who do you want to be in 3, how do you want to spend your time, right? The biggest asset you have in your life is not money, it's time, right? And so I think when you start thinking of debt as an asset and your time as an asset, the other things start to kind of take care of themselves. And that's what I realized quickly is that, in an inflationary environment, the more debt I can take on, I'm 80 million or something in debt, but I probably have, 80 to 100 million net worth as well, right? And I grew up like Dave Ramsey, don't take on any debt, those kind of things. And now it's like, okay, well, I don't think there's any limit to how much debt I would take on if it was income producing debt that was, securitized with really strong leases, right? So I think that you start to think about it differently, and rather than kind of like white knuckling it, you're thinking it in terms of flow of deals and money are like air and water, and it's just how I breathe, and this is what I do, and it's in a different identity, right? And so I think for me that happened through mindset shifting with coaching, and when you come in and you're not looking for what are the barriers or limitations that I have. Most people, make 10% above or below where their parents were. My parents made 35,000 to 50,000 a year. So I think that people have a lot of limiting beliefs around what they think is possible.
Yeah, I want to ask you a couple of questions that I see from the audience. And Kenneth has a great question. And this was when I first came to you to buy my first commercial property. That's what you did with me too, is you sat me down and you said, okay, what are your goals? And let's go through that and then find you the deal that's right for you. And for me at that time, what was important was to add some kind of, appreciation, like forced appreciation to the property in terms of a rehab or rent increase or, something like that, right? So those are the kinds of deals that you started looking for me then. So what Kenneth asked is, for triple net properties, what are some avenues to add value if rents are predetermined in the lease and most expenses are covered? Or is it just an income play?
Yeah, so first off, I think about things in terms of a true investor is looking at cash on cash and internal rate of return. So there's two ways. I see it as some deals are loan pay down, right? So let's say I take out a deal where I'm taking 10 million out in debt and somebody else is going to pay that off for me. I think probably his question, I don't know him, but he's probably potentially a flipper, right? In houses or something like that. He would have to tell us, what his background is, but I would say there are deals where you can try to make money quickly, but then making sure to invest that in long-term assets because, and I've done both. I mean, I have made a lot of wealth through buying properties and selling it, that kind of a thing. So I would say that the cap rate matters less depending on how much you're putting down. So it depends. Some buildings, there are built-in rent bumps like that. Others, you also look for, okay, what are the other comps in the area of, am I going to see cap rate compression? So as cap rates are tied to what you can borrow money at. Okay, so if a bank's going to lend me money at 3.5% and I'm buying a 6 cap or a 7 cap, and that's on an unlevered return of money, I'm going to have a fairly good return. So I think there are some deals where you can do that. And that's why you have to sit with somebody like that. He may want to take a deal that maybe has a little bit more risk, but there's a little bit more upside. Or maybe he should be going after an apartment building where he could go and be hands-on. So that is a good question in how hands-on do you want to be on the property? And a lot of the investors that I work with have day jobs, right? And so their thought is like, I'm paying $100,000, $200,000 in taxes. So if I keep that money and I'm making a return, making 30 to 50% on my money plus not paying taxes definitely can make sense for them. Whereas somebody who maybe has a low income, doesn't have a high, their time may not be as valuable. And so then maybe they should be using their time to be more active in the business. And I do have 4 jobs posted. So if you want to come work for me, we have openings as well. But I think that's continuing to spend time and doing repetitions, right? I think the biggest thing that if that person probably should be analyzing deals. So like we have an investor analyst job open right now. And so they can come in and sit and get good at, hey, this is what we're looking for. Here's the value, those kind of things. But also realizing that as you grow a portfolio of properties, those institutional investors are looking for 10+ million. So let's say you put 5 or 6 deals together that get you into an 8-figure range, you all of a sudden can sell to an institution for probably a point lower on the cap rate. So while you thought that you were buying strictly for fixed rent bumps, all of a sudden you stacked a bunch of 6 and 7 caps together, and then you're selling to a fund or a REIT at a 5 cap. And also, as you get into larger properties, the cap, a small movement in the cap rate is huge, you know?
Right.
So I think that's what I would say is, think about and put a dollar amount on your time. What is your time worth right now? And then, you know, what do you think it could be worth if you're actively involved versus passively investing? And that's why it's going to be different for every person, probably, of what it would be the best course of action.
So we have a pretty good audience question here. All of them are good, but as far as going back into the seller second, seller carry. So when you're controlling the deal, you're double closing, reselling with the seller second. You secure the upside equity in the deal, but the buyer is okay with this because now they're able to have less upfront cash that they're bringing. So I'm sure there's a bank LTV restriction with the debt. You've now alleviated that. They can come in, they can get more of a property, more of a tax benefit. Is that kind of like the goal with all that?
So the reason to do that, the bank lends off the lesser of appraised value or purchase price, right? So what we're doing is you're either double closing, where you sign on the NPA, the property always has to appraise. So you have the appraisal there, obviously ensuring that the value is there, and the bank is your partner. They're underwriting the deal as well and making sure the value's there. Or you're taking your original PA and then you're assigning the purchase agreement, and with that assigned PA matching an appraisal, then that triggers the bank to be able to lend, if that makes sense. So they're going to lend off of the higher amount.
Yeah, that makes complete sense. And you've gone over, seller carries, managing the property. Do you want to be passive? Do you want to be active? How then are you, I guess, finding these deals? Like where are you getting these deals from? It's a relationship thing? Are you doing some sort of marketing? How are you doing this?
Great question. And I think it really does all start with the deal, right? And so I would say a variety of measures. We probably sent 25,000 letters last month directly to sellers. So we have heavy, direct mail that goes out. However, that's probably 10% of the deals that we do. So a lot of it is relationship based.
Wait, how many letters?
Probably 25,000 a month.
Oh my God. And how are you doing this? Do you use a service?
Yeah, so I have guys that help mail for me. We have the capability to do it as well. But, I just don't have enough time, right? Right now, my team is probably a team of 4. So we're continuing to grow, but there are multiple services where you could go pay them. You just got to give them the metrics of, I want this size of an apartment building, I want this size of an industrial, retail, flex office or whatever, and they can send mail for you. But the problem is you have to be ready to handle the calls, right? So you have to understand what is or isn't a deal, and what is something you should move on or not. And you also have to have the ability to get it closed, right? So that's the benefit of us is, hey, if they ask for, can you get this closed? We have proof of funds. We can get letters from the bank, those kind of things. And I think direct mail, it's more of a wide net, right? Rather than like a targeted fishing, you're like throwing some huge net out there and hoping that something sticks. And it does, it's just more time consuming. However, as deals get harder to find, it's something good that you can use. There's call centers, there's direct messaging. The biggest key with that is you have to get down in commercial properties. They're going to have a parent LLC. So you have to get to the guy's home address. That's the most important part. Because if you just send a bunch of letters to some law office or their holding company, they'll never get to them. So we have to have VAs that'll scrub down to the home address and be hitting the guy, as he's coming out for his coffee in the morning, and get him on the right day. And he's like, okay, I've got some health issue going on, or I'm in a divorce, or I've got a big tax problem, or I just want out. I've got enough money. I just want out. I don't want to have to, think about this anymore. Or, when they sell on 1031 exchange, they can get a new set of depreciation. So it may not be just a year-end thing. It may be that they just want to. I had a guy one time, really wealthy developer. He goes, Matt, let's build a relationship and we'll just trade properties every 5 years. And he's like, it was just a funny concept to me of, hey, let's just like partner up on it. And that's the biggest thing that I've learned in my business is when there's a trusting relationship between buyer, seller, and bank and all parties, all of a sudden that's where magic happens. Whereas when you come in and you're opposing parties and you think the other person isn't on your side, then it doesn't work, So I think teamwork is really important. And that's where things have really worked well for me, where I have, you can trust other people that their interests are aligned. And so for instance, if I'm doing a deal where I'm seller carrying, my interests are aligned that the guy performs so that I can get paid my note back. So essentially we're partnering, however they own the property and we're not in the same entity, but they know that I want to come along and make sure that they're successful.
You mentioned something about the mailers, and so you could get if you have 25,000 mailers going out and someone calls you, you have to act like that deal or be ready to be talking about that deal because he's going to be talking or she's going to be talking about the deal, right? So they're going to be probably calling you out of the blue.
Yeah, so there's different ways of handling that. Some you can just be honest and be like, hey, we send a lot of mail. Can you remind me what the address is? I mean, that's one way of doing it. Or you can kind of try to tag them. One of the things we do is use Ring Central. So we'll want to hit them with the local area code, right? So if I'm mailing and I've got some number on there from Florida and the guy's up, he's probably going to be less likely to respond than if it's a local area code that comes in. And then you put them through to a certain phone, and there are different ways to batch them. So you can do that. At this point, I just pay for that, because I don't want to deal with it. But there's a lot of different ways that you can get around tagging that, and they understand too. But I think the biggest thing is trying to target what you're doing, because you can allocate and make sure that you're not, I'm calling a bunch of hotels or mobile home parks that I don't want to deal with. However, a lot of it's relationships. You throw out the wide net and maybe that guy's not selling, but he knows somebody or he knows a broker or whatever. So we just closed a deal down in Fitchburg, a strip center. And the guy goes, oh, these guys are really good to work with. How about you talk to this broker? And now we're buying a pharmacy in Madison from the same guy. And he just sent me another deal. So all of a sudden you'll start to kind of find your people that'll kind of snowball that way. Or people have portfolios. You mail them on one building. And we mailed one guy and he's like, I got $80 million of other strip centers if you want to buy them. And we're like, okay, sounds good. We need to set up a portfolio deal here, and we find that fairly commonly. So if you're able to get in and start finding problems and solving them, it just happens,
Crazy.
Yeah. What I want to know is, like, just for our audience and even my own knowledge, I've worked with other triple net brokers or commercial brokers before where they just find the deal, or I work with lenders that just find the financing. But you're like a one-stop shop where you're sending out mailers, you're finding these deals, you're negotiating with sellers, you're finding financing, and you're like working with local banks, and then you're helping with the exit, 1031ing that into a bigger property, a different property. So if you can walk us through your process and all the different pieces that you put together, I think that would really help understand like the whole piece.
Yeah. So I think the biggest thing, a lot of people don't have success in this because, for lack of better terms, I'm flipping or wholesaling a lot, but I do own about $100 million portfolio that I buy and hold. So I think that establishing credibility to where brokers and those kind of people know that, hey, Matt's going to either buy this himself, which actually I did. We closed 3 transactions today. One of them, the bank didn't come through and I had to close cash. So the sellers are still made whole, and any deal that I do, I'm willing to buy myself. And I think that that's a big difference, and it allows you to be sustainable by, always having the capability to close. So I would just caution you against going out and trying to do it yourself if you, are just going to sign something and you don't have the ability to close. But we put a deal under contract. I'm either buying it. Usually I buy larger properties, so they need to be over 10 million probably for me to close myself. And then, we probably put in the last 2 weeks, maybe 45 letters of intent out. And then maybe we'll get 8 to 10 of them or something. And our goal is to, probably be doing about 25 to 30 deals a quarter. So you're looking at, 50, 60 deals a year, something like that. Sometimes you'll have a little slippage. I mean, we probably close 80 to 90% of the deals we go under contract on. So we'll go under contract, and then, either I'm buying it, go to the bank, get the loan, those kind of things to close, or we're going and talking to, we have about 2,500 investors who are looking for properties. So I have maybe called like, I don't know, 20 of them. So
I feel so honored, Matt.
Yeah, there you go. On the list. I don't know that you were even on the list, so I'm not sure if you count, but there you go. So, but it's just been
off
fun.
market.
We do a lot of repeat business too. So somebody will buy something, and then, if it works well, we're continuing to roll with that, we're small right now. So I think, a lot of the buyers we're working with have, $1 million in cash or something like that. But as we grow, we'll continue to be able to, dip down and do smaller transactions. And the goal is to continue to help people. And I mean, obviously you hit a point where it's like, okay, I don't need to work anymore, but I get a kick out of doing this, and it's a lot of fun. And, we're having a good time doing it. So, yes, Skip, who just said, hey, he bought a ABC Supply building from me, up north. So yeah, it's been
awesome.
it's been a good time. So, so then if we go get an investor who wants to buy something, they'll come in, we'll show them the deal, make sure that everybody, that they are good with the leases, returns. We're helping with due diligence, right? So we're making sure that, that we're looking for rents per square foot, price per square foot that are lower than market. And we're looking for real estate all starts with the location, and we can verify that with, demographics, traffic counts, foot counts, store sales. Like, we're going under contract on 2 grocery stores right now. So like, if you can get those, grocery anchored centers are doing really well during COVID. And we do all kinds of net leased assets, right? So we'll do warehouses and industrial, which is like $4 a foot in rent, or you'll have like flex space, which is some industrial and office. That's more like 8 to 10. Then we'll have office, which is probably like 15 to $18 a foot, depending on, on the lease structure. And then, so it depends on what the building is, those kind of things. And then we help them get the loan. We have lawyers that'll help set up the entity for them. They review title. They, do the assignment of purchase agreement, any promissory note, if there is one. And then they help us, consummate the transaction and help the investor. We have a accounting team as well that can help get the cost segregation done and make sure you get that on. So we kind of hold hands all the way through. And really, that's what happened to me when I got in. Like, I'd never done real estate before, and to go into a bank and say, I need an $8 million loan or $20 million. We just got an appraisal back on a 200,000 square foot grocery anchored center up in Elk River, and it's a $30.3 million appraisal, so I mean, these are some large transactions.
And I think it's we should spotlight the fact that your market isn't LA. It's not like, it's not your market is what, Minnesota, Wisconsin. It's the Midwest, right? That's where you're targeting all of this stuff.
Yeah. We're usually in the Midwest, you get more like cash flow and appreciation. Whereas if you go East, West Coast, that kind of thing, you're going to see mostly just appreciation. You're going to be buying it 5 caps or whatever. And all of a sudden the arbitrage doesn't work between the debt and the cash flow. So we are in different states. I mean, we've closed a transaction down in Missouri. We've closed in Illinois, Indiana. We're working in Ohio. So we are absolutely growing, but you have to do it sustainably, because it's a lot of pieces in place. It's not just, hey, here's a deal. It's like, okay, what are the laws about assigning or double close? Like, every state has differences, right? And so you can't just say, oh, well, this works everywhere. So you have to look around. Like, we tried to go into South Florida and looked, and like leverage was like 65 to 70%. And all of a sudden that doesn't work, right? So you have to understand all aspects of the deal, or have somebody that can help you with that.
Okay. Who's learning something here? I just feel like I want to go back and rewatch this 100 times to get it all in my brain. because there's so many good nuggets here. Okay, so I want to take a quick break and spotlight an audience member. I see lots of amazing questions. I promise we're going to have some time for audience Q&A. And I feel like, Matt, this call can go on for 6 hours and we're still going to be sitting here and asking all these amazing questions. But really, really quick, I want to spotlight an audience member that has really blown my mind over the last year. And I want you to hear from him, hear what he did. And especially if you're new to investing, like you have to go follow him. So about a year ago, I was on a podcast. You might have heard me, and it's called the Bigger Pockets Podcast. And about 5,000 people reached out to me. And one message stood out to me over the 4,999 other messages. And it was this 23-year-old who wrote to me, and he didn't say, hey, your podcast inspired me. Hey, like, how do I get into investing? Or like, there's something that you said that caught my eye. But what he said was, I heard your podcast. I heard your deal criteria. I know what you're looking for. And I built you an app. I built you an app to scrub the listings in your market and send you emails to your inbox that has the cash on cash return that you need. And these are all multifamily listings. And I was like, what the hell? Like, who is this guy? This is amazing. Like he doesn't want anything. And he's just like value add to the 100th degree. And so he intrigued me. And the other amazing thing is that he was moving to Seattle, where I live. And so he said, hey, I'm moving. And I was like, okay, do you want to grab coffee? Because I'm like, this could be an interesting partnership. Like, I just want to know this guy. I want to know what he's about. So he is he joined a company called Facebook here in Seattle, and he's a software engineer. He's 23 years old. And so I ended up meeting him for coffee. And I think it was the best coffee I had in 2020. Because every second, everything he said, his drive, his hustle was inspiring me. And I was like, okay, I want to just help this kid achieve his dreams. And so I want to bring up Kunal Kumar, who he and I have now worked together for the whole year. He is the partner on one of my latest acquisitions. He just raised like 200 grand in capital. And he was like, I don't care where I'm getting the money from. Like, I just want to partner with you. And so that's what he did. He went out and raised money, and he partnered with me. So I'm going to bring him up here. Hi, Kunal.
Hey, thank you so much for having me. That was a great intro.
Tell us who you are and just a little bit about you.
Yeah, so like I said, I'm a recent new grad, so 23. I just recently graduated from UT Austin last year, and I started working at Facebook this past June. So I've been working full-time for a little bit more than a year now. And yeah, I mean, I can get more into my real estate experience so far. But yeah, currently I own a house hack, and I'm not sure if...
I want you to tell our audience. So a year ago, you didn't have any real estate investments, right?
Correct.
Okay. Tell me about your first deal. What did you do? How did you find it? What did you do to it? What is it?
Yeah, sure. So I think like a good thing to do would be to first like go over what criteria I picked like to find the deal and why. So I think basically before I even reached out to Leica, I had pretty much listened to every single Bigger Pockets episode that exists. So like probably at that point it's probably like 400 or so. So I built like a couple of frameworks like over listening to all of these things. So 2 criteria that I definitely wanted in a deal. One thing that I learned from listening to everything was that always take asymmetric risks. So meaning that whatever upside you get is significantly larger than whatever the potential downside is. And the second thing that I learned was that if you want to build wealth slowly over time, like that's a pretty easy thing to do. If you just buy one house every year, do all the basic steps, you'll get there eventually. But I think one thing that I wanted to do is do it a little bit faster. So I think one of my other criteria was that I want to be able to take an on-market deal and generate above market returns from that, because that's something that's a little bit more difficult to do. So basically my criteria was, after listening to Todd Baldwin's podcast, who is also in Seattle, he basically does rent by the room. So he takes normal houses that would probably not cash flow very well in Seattle and makes them cash flow upwards of like 2K a month, 3K a month by renting out each room separately instead of doing it. So for my first deal, it took me a while to find it. So I think I started looking back in like September of last year. And then I was looking for 4 or 5 months because the real estate market was super hot, even more hot than right now than back then.
Right.
So yeah, anything that I was remotely close to what I was looking for got snatched up instantly. So it took a little bit of looking and some luck, but finally in January, I found this one like really messed up house in a suburb called Renton, which is slightly south of Seattle. And so it was listed as a 5-bedroom, 3-bath house. And so as soon as I saw it, I knew it fits my criteria exactly. And I went and saw it literally the day after it was listed. So I walked in. This family was really interesting. They had a bunch of like animals in cages and stuff. I think they were like raising like chickens or something. So they had a chicken coop in the backyard, a bunch of random birds in the house, and it smelled horrible. And I was like, this is exactly the property I need, because I knew that nobody else would want to pick this up. So I basically ran the numbers. I found that while it was listed as a 5-bedroom property, I could actually like do some renovations, some changes, and convert it into a 7-bedroom house. So I basically offered, I think, so the list price was 600K. I offered 612,500, which was above list price, and I asked for a $7,500 closing credit to like cover my closing costs. And so that's how I set up the deal. And then, yeah, I can get more into it depending on whatever you want to know.
Yeah. And so you rehab the property, yeah?
Mm-hmm. Yeah. So actually, so also on the financing part, I guess this is kind of fun to hear also. So since I'm just starting out, and because like rent by the room generates like such high cash flow, I think one of my goals is to like maximize my leverage, because I thought that since I was generating so much cash flow, I could like cover basically any, like even if I leveraged up 100%, like I could still probably cash flow pretty nicely. So after doing some finagling with my lender and stuff, we both came to this idea where since I was only working for like 3 months that year, my W-2 actually looked super low. So I actually like qualified for a down payment assistance, which is just basically like an interest-free loan that the state will give you. So actually what ended up happening is to close on this property, I put about like 6,000 of my own money in to buy it, which is like around 1% basically. So that's how I closed it. And then, yeah, after that, I had to replace all the bathrooms. There was this one like really disgusting bathroom that I don't even think we know the details about, but I had to rip that out. Yeah. And then I added a second kitchen downstairs to make sure that the upstairs kitchen wasn't too crowded, because we do have 7 people in the house. So we needed to make sure that everyone had enough room. So yeah, I think I replaced all the bathrooms, refinished all the floors, added that new kitchen downstairs. And yeah, all in all, that was about like 80K between all of that, new appliances, and then also furnishing all the common areas.
And so, okay, 80K. And then let's come to today. What is it cash flow today?
Yeah, so basically on average, it cash flows around a little bit over 3,000 a month. So if you want to multiply that, annualize that, that's like around 36K, which is like almost like a 50% cash on cash return. Just last month, actually, I decided to rent out the room that I was staying in, because I did get an owner-occupied loan, but I'm trying to get a new owner-occupied house now. So I actually did rent out my room and got like an resident like property manager. So I guess now I'm probably like the only like homeless real estate investor that exists right now. But yeah, so
I love
with
that.
adding on. So with adding the property management, I think I got like a pretty good deal, because like he's one of my friends. So I think after property management and me being completely hands off, it's cash flowing around 2,500 a month.
That's amazing. I mean, kudos to you. That's a killer first deal. You like literally kicked it out of the park. Tell us about how we can reach you. And I know you are up to some really cool things. So let's just get into that really quick.
Yeah, so just 2 things before I leave everyone. I wanted to set up some sort of like mastermind. So I know there are like a lot of other beginners, and like I'm still definitely a beginner. I've only done 1 deal so far. So I think it'd be interesting if I could get like, if there are any like a couple of beginners who want to like set up a mastermind with me, I think that'd be super great. We can probably meet up like once a week, talk about our goals, and then see what else we're working on. So I think I can send a link to that in the chat. And then
Yeah.
also one other really interesting thing that I wanted to try out is I also studied economics in college, and I think like that's something I'm super interested in. So one thing I wanted to do was actually start a newsletter where basically I want to review the top news stories, like either macroeconomic or like real estate related, and then write a summary of it and then analyze like why this is important to real estate and like how you can use that to influence your investing. So I'll send links to both of those in the chat. So if anyone wants to read, I wrote like one newsletter already. So if it's interesting to you, feel free to subscribe. I'll send it completely free every Sunday just so I can also learn more myself. And yeah, I'll post those links in the chat right now and let's see what happens.
I love it. I think everybody go follow Kunal. Like, he has been amazing. He has helped my business so much. I love collaborating with him because he's just such a genius. And so, yeah, do the mastermind, go follow his newsletter. It's amazing. Kunal, thank you so much for joining us. And hopefully we'll bring you back here in a few months and we'll hear about what else you're up to.
Yeah, definitely. Thank you. Also, one quick thing I forgot to mention. I created like a Facebook group for the mastermind. So currently it's listed on private. So just if you're interested in doing that, just click join and then I'll like go through later and like add everybody and then you can sort something out. Cool.
Is that link to your Facebook group then, the mastermind link?
Yeah, that's correct.
Okay, perfect. I will be joining later.
Awesome. All right. Thank you.
Thanks, Kunal. Awesome. Bye. Okay, looks like we lost Brad. His Zoom on open. So you have me. But coming back to Matt, I think I want to touch on something that is super important, mindset. A lot of real estate investors get started, get burned out, don't know where to go from, how to elevate their business. They kind of get lost with not being able to add the right team members or lose vision in some sort of way. How have you been able to stay on track? And because you went from doing small multifamily to massive, like $60 million commercial real estate deals, how did you make the transition?
Yeah, so I think you start with the end in mind, and probably a lot of you have heard about Vivid Vision with Cameron Herold. So I would absolutely recommend you read that book. And for me, it was about creating a 3-year vision. 5 years was too far out to where you wouldn't take action, and 1 year you would underestimate what you could do. So I've set my Vivid Vision twice now, and have hit it both times. Hey, Brad, he's back.
He's back.
So yeah, read Vivid Vision. I would say, listen, if you're not masterminds are huge, right? So like, I'm in a group called GoBundance. I'm in a group called Tiger 21. Probably next year I'll be in another group, and so I think those are super important to turn up the thermostat of who you're around. And I think that's really important. And if you don't have those, listen to podcasts like Bigger Pockets, obviously, but also mindset podcasts. I love Ed Milet's podcast. I don't know if you guys are familiar with that, but Ed Milet is the chairman of World Financial Group. And, he's got a really cool story. He's got a cool faith story as well. So I think those are important. And I think that for me, it was frame. So it was coming from this frame of, does it feel heavy or light? Does what you're doing right now feel heavy or light? And I grew up when it was like, okay, I'm just going to push through things. And, I may not really be liking what I'm doing, but it's what everybody else is doing. So I guess I'm going to keep doing it. Right. And so when you started to kind of shift and say, okay, maybe when you could imagine, like one of the things I'm working on right now is visualization. So the current visualization that I'll have, I love Ed Milet. Okay. So I always think about, if you ever watch any of his stuff, he has this like Laguna Beach home. He has this, it's probably $25 million home or whatever, but he goes out and has coffee on the beach and walks up and down the beach. Right. And there's something calming about water. Right. So I have this vision of, hey, I live in a beautiful home. I walk out in the morning and I have coffee while I walk along the beach. I can have those visualizations. I can pray. I can call other people. I've got this dog there. I've got a family. I have kids, So I think that when you sit and you can speak something into existence, right? And so I think when you start to have these affirmations of, for me, it was, when I was in coaching, Jason Drees would be like, he's like, repeat after me. I take full ownership of my life and everything in it. And then he would say, I have chose to believe this, whatever the X is. Going forward, this is what I choose to believe. All versions, past, present, future of me, and so it is. And it's like speaking that into existence. So maybe for someone, it's like, I take full ownership of my life and everything in it. I currently work at a job where I make $50,000 a year and don't see a way out, and I hate, my life or whatever. And they say, I could see a future version of myself where I have as much passive income as I need, and I live with this beautiful family in this place that I love, and I give back to people, and it's very meaningful. And so for me, it was kind of creating that vision that you can walk through every morning and have that reminder. Maybe it's simple. Maybe you put it as a screensaver on your phone of here's my 3 goals, and then chunk it down, right? Then take 90-day actionable steps. So you create the 3-year vivid vision, and then you get a journal and you start working on 90-day sprints of what am I going to do to break this down and eat the elephant one piece at a time. And so maybe, and as you focus on those lead versus lag measures, maybe it's calling 10 brokers. This week, I'm going to call 10 real estate brokers, or I'm going to take a class on how to understand commercial real estate, or whatever it is, right? I mean, you could be buying a business, those kind of things. So I think that for me, mindset's been everything. And I'm still working on it. Like even now, believe me, I have not arrived. Like I got a lot of things that I'm still working on. And that's the process. And I think it gives purpose too. So choosing what you're going to listen to, who you're going to listen to, and really not, it's like changing channels. You know what I mean? It's like if you're listening to a radio in a car and you're listening to the country station and you want to be listening to something else, you got to change the channel, and so I think that's the biggest thing. And time, again, is that asset. So if you're watching Netflix every night, maybe a simple thing of saying, I'm going to listen to, a couple podcasts, or I'm going to intentionally call these people, because it's habits, right? For me, it's been, I just get up, and now I have employees. So I have to show up to morning meeting at 8:30, and they're expecting me to be there, right? And so it's creating systems and processes, and eventually get to the point where then it's who, not how. And it's like, how do I, if you want to be a billionaire, you have to learn how to quit, like Brandon says, right? So what are you willing to quit in your life to have what you really want? And most people, there's this kind of fear of letting go of something. So and I think that's what I'm working on now, is what energizes and drains, and what am I going to say no to so that I can have what I really want in life.
Oh, I love that. So what is your why, Matt?
Yeah, well, I believe in God. I'm a man of faith. And so I believe that, what we do matters, but I love investing, but investing in people matters more than having money, right? So actually today, my brother and his wife, my brother's a St. Paul firefighter. He just bought his first commercial building today that I helped him buy. And, they have 2 little kids, and, his wife stays home, and eventually he'll be able to stay home because of this building. I think it'll give him about 50,000 roughly in passive income. And so it's creating that time freedom for him and investing in him. My parents have also, bought a building, those kind of things. So I think that, coming out with this book that I'm going to do, I think will change a lot of people's lives and give them tools to give them their time back. And I think ultimately for me, I go to church, and, I really believe that's something that's changed my life a lot, is finding purpose, because Tony Robbins would say that, success without fulfillment is failure. And so we don't want to just have a lot of money. We also want to have fulfillment. And that's what I've been working on. So that can look a lot of different ways for different people, but finding something that isn't, because otherwise you'll show up and you'll get all the money and you'll get everything you want and you feel empty, right? And that's worse than not having it. So that's what I would say is, work along, grow all areas of your life at the same time so that you end up where you want to be.
I love what you ended that with. It's funny, my brother's on this call, and he just private messaged me, and he said, see, I like his idea. Like, you should find me a deal that passively make me 50 grand a year. So the pressure's on.
Right. That's right.
Right. Okay. So I want to end with some super, super exciting news. Like Matt mentioned, he is writing a book. And what's exciting is that a lot of people, like I think the number one question we got from our audience in filling out the form to register for the meetup was, what podcasts should I listen to on commercial investing? What books should I read on triple net investing? And so I'm so excited to announce to everybody that Matt is writing a book. And tell us what it's called.
It's the Insider's Guide to Triple Net Investing. So I felt called to write this book just because I saw all these books on, multifamily and that kind of a thing. And, this has been an old man's game for so long. And so my goal is kind of to, help empower people to get into that space and really to think bigger, I think, overall.
Right.
So there's a lot of ways to get there. And, I just want to, get there an easier way, faster.
Okay, so Matt actually was gracious enough to send me the first few pages of the book a couple months ago. And I ended up reading it and I was like, damn it, I want the whole book because it was so good. I was inspired. I was like, oh my God, this is like the most well-written book on a pretty boring topic. So I was super kicked. So I would love for you to read, like maybe just the beginning, maybe a couple pages from the beginning of the book, because it's coming out soon. When is it available for?
We have a landing page coming out where people can pre-order stuff probably in the next couple of weeks. October 22nd, we'll have the fully edited version back. Actually, we're talking with Bigger Pockets about publishing next Thursday. So there'll be quite a few months before it's truly published, but we're happy to get it out for everybody.
Amazing. Okay, give us a little teaser.
Yeah, so the intro says the simplest way to be a millionaire, ? 2 years ago, I was one of the most highly trained anesthesia professionals in the world working at the renowned Mayo Clinic. Each day I stood side by side with some of the planet's most talented surgeons, from routine appendectomies to emergency heart surgeries and organ transplants. I was there from the beginning to end, doing one of the most critical jobs in the room. It was important work, life-saving work, and it was killing me. For exhausting 16 or 24-hour shifts, I would track numbers, change dials, and simply watch the time pass. And through it all, I would hear the beep, beep, beep of the patient's heartbeat. That heartbeat was the most important sound in the room. That steady beat meant everything was okay. That heartbeat was 98% of my work, and it became the soundtrack to my day. Beep, beep, beep. The other 2% of my job was spent in a state of high-stakes chaos. Complications would arise, patients would crash, things would get very real very quickly. In those moments, the beating of the heart monitor would change, slowing down or speeding up. My soundtrack of beeps would become wildly erratic, or worse still, merge into the solid tone of no heartbeat at all. All told, my job resembled a kind of controlled war zone. Almost nothing happened all the time, and then shit got real in a hurry. It wasn't uncommon for me to go from near boredom to intense focus in the space of a single heartbeat. Then somehow, at the end of a shift, I was supposed to turn off the experience to go home and relax, as if the balance of life and death was just all in a day's work. And maybe I'll just stop there. But the goal, I'll read this next section, but I wanted to communicate to people the feeling that I felt, and this is the motivation of really why I went on. I said the problem, of course, that was my days didn't turn off. That beeping didn't go away. Instead, it began to haunt me. It was as if my whole life was being measured out by the heartbeat. I'd grown up believing that my success was a simple path of consistent steps, like one beep after another. Go to school, get a good job, beep, beep, beep. Work hard, get promoted, beep, beep, beep. Save your money, wait for it to grow, beep, beep, beep. The hardest part was that gaps between the beep. They were painfully long, like the endless wait for the next heartbeat of a patient at risk. And the longest wait of it all seemed to be the wait for financial freedom. Waiting for payday was a 2-week beep. Paying off student loans would be a 10-year beep. Paying off my mortgage, it would be a multi-decade beep. The more I looked around, the less hopeful I became. I saw physicians who had good incomes, but no net worth because they didn't know how to invest. They overspent to keep up with the Joneses, carried large consumer debt, and they paid most of their income out to taxes. And I was following that same pattern. Beep, beep, beep. This was the great irony of my world. My job was about saving lives, but I was dying a little with every shift inside, and I needed out. So that's how I felt. And, you know, I think that I'll read a little bit of this portfolio. Triple net leasing, where the tenant, not the owner, is responsible for the ongoing expenses of the rental building, allows you to buy more with less and get better returns with lower risk. It allows you to grow a portfolio faster than you could ever in any other form of real estate. And it's incredibly passive. It's what they call mailbox money. You get the check in the mail and deposit them into your account. Now that's in a digital age, it's even simpler. It also transformed my life. About a year and a half after I bought my first triple net property, a story you'll hear shortly, my portfolio has reached almost 80 million. My income was approaching 2 million, all of it passive. When I look back over time, the thing that stands out most to me isn't how much things have changed financially. Yes, the spreadsheet of my life is certainly different, but I found the financial freedom I so desperately wanted. But it's not the spreadsheet that surprises me the most, it's the soundtrack. The beeping is gone. Even though I still have hospital privileges, my life feels completely different on the inside. The new soundtrack of my life is completely different. It's positive, hopeful, empowering, and exciting. To be clear, I worked hard to make it happen, but also got lucky, and then I found a way to create wealth and freedom, strangely, most people don't seem to be aware of. I still meet seasoned real estate investors all the time who have no idea just how powerful triple net investing it really is. And I wrote this book to change that.
Love it. Oh my God. Just keep reading.
Yeah. Sorry, I was like reading, I'm like, boy, this is gonna get long.
I think there was one thing in that, and I know we're trying to get to the networking part here. You mentioned, we had a question from Barath earlier, which this kind of comes back to one of the sections you had there. He asked about how are you managing properties in other areas like Ohio? Like that's the beauty with this, because I asked this to you the other day. You're not managing these. Mm-hmm. You're buying it, it's gone. You don't have to manage these things.
Yeah, so when an investor buys one of these properties, part of the triple net piece is that the management's paid for by the tenant. So you'll get an email once a month. It's a rent roll and a P&L, or a profit and loss statement. And yeah, maybe you'll get a call if you're putting a new tenant in a building or making a higher level decision. But essentially that's, you're starting to move into a level of wealth where people manage things for you, and eventually, like I'm looking at probably next year engaging a family office to start being involved with the stuff that I'm doing that I never thought. And then you're talking trust and you're talking all this kind of stuff, right? So I think that when you start thinking about it that way of, hey, my identity is I'm the investor, things start to change. But yeah, you won't be managing this yourself.
Yeah, I think that's a key point, because I asked the same thing. I'm like, how are you doing? Like now you've had to start a management company and start doing it. It's like, no, you don't have to do that. And that's just my ignorance to the issue, and that's why we have you here, because you're an expert on it. It's just been the chat we had the other day, and then now it's been amazing. So we appreciate you taking the time to sit down with us. Like, I don't know if you have a follow-up or anything.
I just want to say thank you. This was amazing. I know, seriously, we got to do a deal together. I have just enjoyed this so much, and I hope our audience has too. We're going to jump into audience Q&A for the next, 15 minutes. So if you guys have questions, and I know you probably put in some in the beginning or in the middle, we just have to go back and look for them. So just type it again now so that we can go through these questions with Matt. Okay, we're going to start with Brian. Brian says, how do you deal with the short terms on commercial loans? That is the balloon payment due in 5 years.
Yeah, so the reason why you have balloons or kind of, a rate adjustment is just from exposure from the bank. So the banks, when they lend money, it's based off of the feds will give them money. So in the same way that I'm investing and trying to make a return, the bank's doing the same thing and trying to make a spread, right? Right now they may be borrowing money at 1%, and then they're lending it to you at 3.5%, 4% or whatever. So that can be adjusted, and you can also negotiate with banks. But in general, banks are going to kind of give you a loan that matches the term of your lease. And a lot of times it's, you know, that's the 3 to 5 year loan. And just because it says balloon doesn't mean that you're going to have, most of the banks are just going to give an extension letter of just like, hey, you know, this is what the interest rate is at this given point, and we're going to just extend you at that rate. And you, at that point, can decide you're either happy with that, or you'll go and play it off multiple other banks to get the rate that you want. So, and it's that irony is the more that you have, the easier it is, right? So if I am like, I'm maxed out on 2 banks, like I'm literally at their max lending limit. So they're not going to want to lose me, right? If we get to the end and they're like, oh, Matt's going to take 15 million in loans to another bank, they want to keep me. So you start to become an asset to the bank, and they're your partner. So this isn't like some, you know, and a lot of people say, well, you know, I think the 2 biggest things I would say that I always watch for is vacancy and CapEx, right? And so in a situation where you'd have vacancy, these people want to work with you. A lot of times you're going to have a year notice if somebody's going to leave. But even if they do, you can go to the bank and say, hey, can we go interest only on the loan, or can we defer mortgage payments, those kind of things. So the bank is absolutely going to partner with you. If you want to lock in a longer term, like a 10-year term, usually your rate's going to go up. So, and we believe that we're going to be in a prolonged low interest rate environment, because as the government prints money, they don't want to increase rates, so they're going to have to pay it on their own debt. And that's a whole nother macroeconomic kind of discussion to get into, but we believe that we're going to be low for a while. And you can see that internationally in European economies and other things like that. I'm going to get my power cord and you can keep talking. I'm low.
Do it.
We've seen this a few times, so I'll just kind of ask this: what can you assign a contract with a sale leaseback, and what's, if you want to talk about what's been your most profitable I guess assignment that you've had?
So absolutely you can assign it. And an assignment, all an assignment is doing is basically saying my ownership interest in a property, I'm going to give the rights of this contract to someone else. And you know, one of the things, again, this is mindset and identity kind of a shift, is a lot of people, brokers are broke because they think of themselves as transactional and that they would work for a fee. Whereas my identity is that I'm the owner of the property, right? So that mindset shift, just that one little nugget, when you start to think of yourself as the owner, when I put the property under contract, I all of a sudden what's called equitable title. So when I tie a property up, I now, in my mind, I own the property already. So therefore, now it's like, okay, well, what is market, or what can I make market by, you know, adding value through a sale leaseback, that kind of a thing. So yeah, I've done a couple where we go under contract, we structure the lease, and then we're signing everything through. We have a legal team that obviously makes sure they're drafting the lease and those kind of things. And, you know, attorneys are expensive. I mean, we're probably looking $8,000, $8 to 10 grand to close, depending on, especially if you're drafting a new lease and working with assignments, that kind of a thing. Most profitable transaction, we have a portfolio right now that's 326 apartments and 4 warehouses, that the spread will probably be somewhere around 10 million.
Nice. I got another question follow up from Mr. Travis Bowers. So if anyone hasn't connected with Travis Bowers, he's a genius. Reach out to him, follow him LinkedIn. But Travis asked, how does the lender deal with the seller carryback? Do they allow the holder to take a second lien on the property, or how are you structuring that? So it's not like, are they taking that seller second and then adjusting that with the LTV, so they give you 80, or are you doing that outside?
That really depends on the lender. So lenders can make exceptions to loans. So federal lending limits, and this is getting into a really fun discussion. So usually by law, a bank can go to 85% LTV. Now, however, they can go in, they can give lines of credit. The same bank can give lines of credit or second mortgages. So right now I've got 180,000 square feet of office, and the one bank had a lending limit of like, I don't know, 19 million, and I needed like 30 million or loan or something. So the same bank is going to give us a first position loan and a second position loan. One's going to be like 18 something million. The other one's going to be 11 something million. And so when you start to understand, and banks can make exceptions to certain loans. So all of a sudden, if you have somebody who is on your side, on the inside of the bank, they can start to figure out, okay, what's the best structure for the debt here? So in that scenario, if you go over what a normal bank's lending limit is, they usually have to participate it out to other banks. But that bank decided that they love the loan, they love the guarantor, and they were going to keep it all in-house, right? So they were able to basically originate 2 loans in the same property. So in that scenario, but yes, you can put a second mortgage on the property. It depends. That's going to depend on lender to lender of what they're going to allow or not allow. But the bank in first position is still, going to get paid off before anybody else does. So it really depends. One of the things that is helping me now is I'm sitting on a lot of cash and that I want to use. So I'm getting ready to go out and we're going to get a $20 million line of credit from a bank that we're going to collateralize with a bunch of buildings and maybe some cash in their bank to be able to deploy it. So even once you get to a certain level, you're always thinking, okay, how do I use somebody else's money to just sit around rather than having my capital sit around? So that's what I would always think about, is how to maximize dollars.
I feel like you took 10 years of investing experience and like jammed it into one. Full disclosure, Travis is also my asset manager and he is amazing.
Awesome.
So you connect with him. Okay, I like this question from Andrew. How many contracts are you assigning versus taking down yourself?
I take probably down, depends on at a given point. Right now I'm taking probably close to half actually myself, 30 to 50% at any given point. I've got a $52 million building in Rochester that I'm in the process of buying. I have a 315 acre farm that I'm actually buying, and then we're splitting lots off. We're building 138 units right now in Rochester. So again, those are not things that I'm great at, but I have mentors that are good at them. Right. And so I'm just like, okay, if I don't have to sell the stupid thing and it's worth more, the same or more than, what I paid for it, then, why wouldn't I do that? So like with the land we have under contract, we're buying at 18,000 an acre. They're saying it's worth 23 an acre right away. So you put the farm under contract, you could sell the dirt for $1 million, $1.5 million more than what you're paying right away. So in answer to that question, it depends on the time and season, but our goal is to have everything inbound. So we have enough leads coming in that I close as many as I need to, and we, can help investors, because obviously we have way more investors than we have properties at this point.
Yeah. Okay, we'll take a couple more questions and then we'll go into breakout rooms. So there's a question here from Jake. What do you think beginner investors, so investors just starting out, underestimate when starting out in real estate?
I think that beginner investors probably underestimate the power of having the right mentor, and you have to provide value to them. Okay, so one of my main mentors is a vice president of a bank, and I probably made him $1 million a year for the last 3 years in commissions. Okay, so he has interestingly enough, now every Monday he'll drive an hour. He and I drive an hour each way to have breakfast together at this like small town breakfast place on the river. Even to this day, like even Monday of next week, we're meeting. So that's what I would say is like having somebody who can turn decades into days for you is really important. So even now, I don't know how to flip. I don't know how to do land, flip land lots or, sell them to home builders or build apartments, but I go and I get the contractor and I understand the math. And so I understand, how we can force that kind of a thing. So I would say that, and I would say, don't underestimate the power of habits. So if you create health, like if you go work out once or run once, like don't expect much. But if you call 10 brokers a day for a year, that's 520 brokers that you're going to have talked to, right? Or what, I mean, like eventually you're going to get it'll eventually come. And in medicine, I was always about perfection, right? It was like, I had a 4.0, but then I got into business and like, I had a deal not closed today that I had to close cash, right? And so that can be really frustrating for somebody who's perfectionistic. But if you just create those habits of, hey, I'm going to fail forward, I'm going to keep doing this, I'm going to have some hiccups, it's not going to go well, but I know that business is going to take me farther than medicine or my day job or whatever. You can kind of take it all in stride and with the right mindset.
If you if you made me $1 million, I'd drive the 16 hours from Port Huron to wherever you are in Minnesota once a month to meet you for breakfast as well. So, so only an hour. That's not that big of a deal, right? Bastian has a question. See Bastian on LinkedIn a lot. Keep up the good work with that. How did you build your investor list? I'm sure it's probably what your network from the hospital, and then GoBundance probably helps out a lot, but I'll let you kind of talk on that.
Yeah, so I give a talk on Bigger Pockets and had about 2,500 to 3,000 people reach out. So I would say that was a huge one. But I mean, I have a lot of people who, I have a guy who is a Coinbase employee, they IPO'd. I've got a guy who sold a bunch of GameStop stock, has, got a thing of like people who, a lot of my buyers have really high income that basically, need help with that's an ideal buyer for something that's turnkey. Whereas somebody who basically doesn't have as high of an income, they're going to be a lot more active in this, working with us may not make sense for them, but the principles they can go use, on their own and be able to turn over an opportunity. So, and I would just say, like, if that person's asking to try to find people himself, I would say get in those situations. So like here locally, there's a North Star Real Estate Conference. So like go to those, like go find those. I mean, wherever that person is, whether it's Denver, Seattle, or whatever, like go to a conference or meetup and go, or go hang out with other people that, rock stars know rock stars. And if you go find one, they're going to be there. It's like where the smoke is, there's fire. No, I'm just kidding.
I cannot agree with you more. Network. Okay, we're gonna close this section out. I know there's one last question from Bharat, and then we'll close it out. So when you started investing out of state and buying commercial deals, did you have someone that you trusted locally there, and how did you find that team?
Yeah, so as far as going out of state, a lot of times we do have brokers that'll go with us that know that kind of stuff, but this is not like when you have a triple net lease, the due diligence is not near as hard. Okay, so it's not like, if you're buying a Walgreens, if the Walgreens is in St. Louis, Missouri, or Minneapolis, or Madison, there's not as much variance. It's not like, hey, what kind of housing is here, or those kind of things. So it's due diligence on triple net properties is significantly easier. I'll start with that. And getting the comps. I mean, when I would learn how to underwrite these, it was having coffee and donuts, and it was flipping over the back of a napkin and saying the net operating income is X, and here's the cap rate we think, and that sounds good. I mean, like literally, I bought $10 million buildings that way over a cinnamon roll and a coffee, and I still do to this day. So like, it's different than, hey, is this B plus, multifamily, and I have to see every single unit. And when I buy it, the taxes are going to go up because they're not passed on to the tenant, and the management company, is bad, and they have a bunch of deferred maintenance, and you know what I mean? It's just a different conversation. So going to a new market is not difficult. And really you're buying a stream of income as much as you're buying a physical building.
Well, Matt, thank you so much for your time. Just so our audience knows, what is your BP podcast episode number?
416.
416. And can you put a link to your website?
Absolutely. It's wildmooseventures.com, and I can put that for you in the link, or Matt Onofrio on Instagram.
Amazing. Go follow him, because he is just a wealth of knowledge, and he's just absolute fire. And thank you. Is anything you want to leave us with?
No, I think just like anybody can do what I can do, right? I mean, my fear of coming on these kind of things is like, oh, well, that you're not relatable, right? So my goal is like, hey, 4 or 5 years ago, I literally crocheted a blanket to try to get a scholarship for school. Okay. I mean, I was working random jobs, and like, I know what it's like to be living with roommates. I still live in a $180,000 house, right? So I think that it's okay to, that anybody can do what I've done. That's what I want to leave you with.